Resilience in the Storm: How the Philippines Weathered the 2008 to 2009 Financial Crisis. The international economies were shaken by the 2008 to 2009 global financial crisis, which left a wake of instability and economic ruin. But despite the mayhem, one country, the Philippines, managed to survive the storm with surprisingly strong fortitude. In this video, we examine the variables that protected the Philippines from the crisis' harshest effects and consider the lessons that might be drawn from its extraordinary achievement. We will also examine how the government improved its monetary policies and restructured its banking system in the past, learning from the financial crisis of 1997 and the demise of Banco Filipino. Liking the video, hit the like and subscribe buttons. 1. Banking System Restructuring. After the Asian financial crisis of 1997 exposed flaws in the nation's financial institutions, the Philippines started on its path to developing a strong banking system. To increase the sector's resilience and response, the government carried out extensive changes. Stricter regulatory frameworks, improved risk management procedures, and greater transparency were all part of these reforms. When banks are undercapitalized, have lax lending standards, and are subject to insufficient oversight and regulation, they become a source of regional and global systemic risk. The Bangko Sentral ng Pilipinas (BSP) was crucial in putting these reforms into effect by ensuring that banks followed prudential guidelines and preserved the stability of the financial sector. Key performance indicators that also demonstrated the soundness of the system as a whole indicated the resiliency of the Philippine banking sector. Bank lending increased once more, and the ratio of non-performing loans decreased, causing the asset quality to improve even more. The Philippines has higher bank financial strength than its ASEAN neighbors, as reflected in Moody's ratings, BFSRs. 2. Improved monetary policies. The BSP changed its monetary policies to be more cautious and proactive as a result of the lessons it gained during the 1997 crisis. The central bank maintained a diligent approach to monetary policy, because it understood how crucial maintaining price stability and controlling inflation was. For instance, the BSP continued to reduce the reverse repurchase policy rate, RRP, from a peak of 15% in 1997 to 4% in 2009, which reduced shocks to banks and businesses. The BSP successfully navigated the difficulties brought on by the global financial crisis of 2008 to 2009 through timely adjustments to interest rates, reserve requirements, and open market operations. These steps preserved public confidence in the Philippine financial sector while protecting the Philippines from the worst repercussions of the crisis. 3. Minimal credit exposure. Data from the Banco Sentral ng Pilipinas (BSP) show that loan growth remained moderately poor in the years after this crisis, in contrast to a greater growth rate of 12.7% in 2008. System loan growth slowed during the 2009 financial crisis to 8.7%, and further to 3.9% in 2010. In reaction to the economic difficulties brought on by the crisis, financial institutions and borrowers adopted a cautious stance, as evidenced by the muted loan growth. Fascinatingly, the Philippines didn't notice a significant acceleration in loan growth for about 3 years following the crisis scene. The data shows that the country only noticed a significant surge in credit expansion in 2011. The Philippines prioritized stability and prudent lending practices in the immediate wake of the crisis. This gave the economy time to heal and restore strength before enabling a more strong lending environment, as seen by the delayed increase in credit growth. 4. Lessons learned from Banco Filipino's demise. A pivotal event. The collapse of Banco Filipino in 1985 demonstrated the necessity for more stringent regulatory oversight and prudential measures in the Philippine banking industry. The government adopted changes targeted at improving the stability and soundness of financial institutions as a result of this incident, which served as a catalyst for change. To stop similar failures from happening again, stricter capital requirements, better risk management procedures, and higher governance standards were implemented. The banking system was subsequently overhauled on the basis of the lessons learnt from the Banco Filipino collapse, enhancing its resilience and putting it in position to face new problems. And finally, the Philippines' proactive effort to revamping the banking sector and strengthening monetary policy can be credited with its ability to weather the financial crisis of 2009, using the lessons learned from the 1997 financial crisis and the failure of Banco Filipino. The government put into place measures that gave the banking industry stability, transparency, and responsible risk management procedures. These steps made sure that the nation's banking sector remained strong and able to withstand financial storms on a worldwide scale. The success of the Philippines is an inspiration to other countries, demonstrating the value of ongoing reforms, rigorous regulatory scrutiny, and proactive monetary policies in creating a resilient financial sector that can endure economic crises.
But there's more to money than being just a tool of commerce. It is a representation of peoples and their stories.
Click the description below to know more about Banco Filipino's closure. Don't forget to smash the like and subscribe buttons. Thanks for watching.